This is Linda Hitt, and we're going to take a look at the input in the accounting system done manually. So we're going to look at some basic journal entries for the first month of a company, and we're going to look at the formatting for a manual system where something's handwritten in or entered, and we'll look at the way the journal entry is set up. We'll also look at the impact on the financial statements of preparing a certain journal entry. We're looking at the dual entry system of accounting, which has been around for a long time. Each transaction has to have at least one debit and one credit. As you know, the accounting equation is assets equal to liabilities plus stockholders' equity. Assets are on the left side of the equation. Assets go up on the left side of their T or ledger account. So you would debit assets to increase. Liabilities and stockholders' equity are on the right side of the equation. They go up on the right side of the T or ledger. So liabilities and stockholders' equity increase with a credit because the left side is always the debit, the right side is always the credit. Then we have retained earnings accounts. We set up temporary accounts to give us enough information to do the income statement. So we have revenues, expenses, and dividends. Expenses and dividends are recognized. They increase with the debit, and revenues go up with the credit. Unfortunately, you have to memorize this, but the more you do journal entries, the easier this should come. So let's go ahead and take a look at some basic journal entries and do a short problem. So here we have journal entries in the middle, the format, the paper in green. Notice there's a place to record the date, the account titles under description, and then the dollar amount for debits and credits. On the right side, we'll eventually also talk about the impact on the balance sheet, income statement, and cash flow. So the first thing we have is that we acquired cash from issuance of stock. So to raise some money for the business, we have some new owners. We brainstormed the accounts. We need cash. Cash is an asset. Stock would be common stock, and that's part of stockholders' equity. So to increase an asset, you're going to need to debit, and to increase common stock, stockholders' equity, you're going to do a credit. Looking at the balance sheet, we find that we have more resources, so our assets have gone up, and stockholders' equity is also increasing. No impact on the income statement, no revenues or expenses, and cash flow is increasing, and that's a way of raising money, so it's financing. Next, we paid for rent, and we have 1 month only for the rent, so we're going to look at the cost of doing business. We'll have rent expense, and the word pay tells us cash goes out. So we have actually two assets. It's an asset exchange, so prepaid rent is going to be increased with the debit. We write that first, and then cash, the asset, will be decreased with the credit. And so as far as the balance sheet goes, total assets will not change. We could put a plus and a minus, or you can just leave it blank. No change to liability, stockholders' equity, no revenue and expense at this point. And the cash, of course, does decrease, and that's part of operations, the day-to-day stuff. Next, we paid for insurance, but this time we paid for the entire year. So it's not just the cost of doing business for 1 month. So we're actually going to use prepaid insurance instead of insurance expense, and that's an asset because it benefits the future. And we paid for this, so we have cash going out. So we'll have prepaid insurance, the asset increasing with the debit, and then we'll have cash, also an asset, decreasing with the credit. So once again, it's an asset exchange like the previous transaction. So we have a positive and a negative, or just leave it blank for the assets. No liability, stockholders' equity, no impact on net income, no revenue or expense, and cash is going out. It's going to be operating. Even though it's an asset, if we paid insurance monthly, it would have been insurance expense. All revenues and expenses with cash flows would affect operations. Then we go on to borrowing money from the bank, cash comes in, which is an asset. We promise to pay money to our creditors to the bank, so we have a notes payable. Cash would come first because that's the debit with the increase, and notes payable would come second because that's the credit, increasing a liability. So as far as the balance sheet goes, we have cash increasing and assets increasing and liabilities. And so that balances the balance sheet. Once we have interest expense, we will affect net income, but we don't have to worry about that when we first borrow money. And we have cash coming in, and it's part of financing. Next, we bought land with cash. So this is again two different assets. It's an asset exchange. So land increases and cash decreases. So as far as the balance sheet, it's a plus and a minus, or no change to totals. And income is not affected, but for cash flow, we have cash going out, and this time it is investing. We next purchase supplies on account. On account tells us no cash. So supplies is something that benefits the future, so we're going to consider it an asset. It'll become supplies expense only when it's used up. And then on account will be either accounts receivable or accounts payable, since there is no cash. We're promising to pay money in the future then, so we have an accounts payable, which is a liability. For your balance sheet, you have more resources, so you have an asset, but you're also promising money. So assets and liabilities go up, which balances the balance sheet. Net income is not affected until supplies are used up, and there's no cash. Next, we go to January 20th. We recognize service revenue on account. So there's the terms on account again, no cash. So this time, if we perform a service, we have customers promise to give us money. So we're going to use accounts receivable, which is an asset. So to increase that, I'm going to debit accounts receivable. And I've earned a revenue, so I'm going to pick up service revenue as a credit. That's how we recognize or increase revenue. And when we get to the balance sheet, we have more resources because we have the customers promise to give us money. Service revenue is a retained earnings account, so stockholders' equity will also go up. It's good news for profits on your income statement. That's going to increase, and there's no cash. So we'll get cash later, hopefully. And then January 21st, we pay for supplies purchased back on January 15th of $500. So we don't have to repeat the supplies. We've already recorded those. We simply need to reduce our accounts payable because we are paying it, and cash, of course, goes out. So we debit accounts payable. That's going to go down for $500, and then we credit cash. So on the balance sheet, we see assets decreasing, and we also see liabilities decreasing. No impact on the income statement, and for the cash flow, we're paying for supplies, so that's certainly part of operations. Then we go on to salaries. We're paying for just the month. So the cost of doing business, we have salaries expense and cash. So we put the expenses first because we're usually always debiting expenses to recognize those. And we have cash being reduced. For the balance sheet, we see less resources. Salaries expenses retained earnings account. After closing, we'll see stockholders' equity going down. Expenses reduce profits, so our profits are less on the income statement. And finally, cash is going down and the section is operations. Next, we collect cash on accounts receivable. So we had the entry for $2,000 on January 20th. So now all we're doing is collecting $1,500 of the $2,000 from January 20th. So we have more cash. That's going to increase, and our accounts receivable is going to decrease. So it is an asset exchange. One asset up, one asset down. So on the balance sheet, you can just either leave that blank or you can show a plus and a minus. Nothing else changes for the balance sheet, no effect on the income statement. Finally, with cash flow, we see cash going up, and that's operating. Next, we're going to recognize revenue and receive cash right away. So cash and service revenue. Cash would go first as an increase to assets. Service revenue would come next as a credit because we've earned the revenue. For the balance sheet, we have more resources. Service revenue as retained earnings would increase stockholders' equity. So there are the balance sheet balances. It's good news for the income statement. We have more profit, and it's also good for cash. Cash from operations will be increased. Then we pay a dividend. Cash will go down in the account dividends, or we could actually debit retained earnings here. Either way will work. So we have dividends written first, or retained earnings as a debit, and cash comes second as a reduction to assets. So the balance sheet, assets go down. Dividends is a retained earnings account, so that also decreases. And for many of us, we want to somehow affect the income statement, but dividends are not on the income statement. It's not an expense. So there is no impact on the income statement, and for cash flow purposes, we see cash going out, and this is actually put with financing because common stock is with financing. Rewarding owners who hold common stock, also financing. Okay, next we collected cash in advance for services to be performed in the future. So here we do have cash in hand, so we've got to make a journal entry, but we're not yet entitled to say that we've earned the revenue. We have not done the work. So what we have is cash collected, so cash is going to go up, but we're going to have to promise to do the work. So we have a new account. Take the word unearned and stick it in front of your revenue account. So unearned service revenue, which is a special type of liability. So the balance sheet's going to show an asset increase and a liability increase. So there's balancing the balance sheet. No impact to income statement because you haven't earned the revenue. It's really is a liability account. And then finally, cash flow statement, we don't care if we've earned or not. It's going to show up, and it's going to be under operations. Whoops. Okay, so next we're going to look at the signing a contract to perform services. And we haven't done any of the work. We don't have any cash received, and we've done nothing for it. So on January 31st, when you look at this, there really isn't any impact to the accounting equation. No change to assets, liabilities, or stockholders' equity. So actually, this one does not need to be recorded. Once cash comes in or we do the services, then it will get on the books. So this concludes the video on the daily journal entries. We'll have a separate video for the adjusting entries, posting, and so forth.